Well, that was certainly very interesting to see on Friday. Fed Chair Powell coming out and maybe giving the markets exactly what they wanted. But the way that the markets behaved today as the dust settled and everybody had a chance to think over what happened over the weekend was eye-catching, if nothing else. And we're going to try to figure out exactly what is happening here. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And as ever, when we look at these things on Monday, we usually look at the week ahead. So we'll try to unpack what the markets were telling us with this speech and why the markets reacted the way that they did. And then from there, go through and attempt to figure out what may be on the menu next, because, of course, we do have an interesting sort of circumstances shaping up here for these markets in the days ahead. And the price action is certainly not as clear cut as might have been surmised were we to look at the way that these markets performed on Friday. So let's break this down here. Here's what happened in these markets last week in aggregate. You can see the S&P 500 had a relatively modest rise, 0.2%. The NASDAQ actually ended the week down 1%. Rates down across the board, no big surprise there. 10-year down, the 2-year down off by 1.5% apiece. Crude oil continues to do its own thing and beating to the beat of its own drum. Gold up, the dollar basically flat. Euro up 0.1%, yen up 0.2%, so not a whole lot going on. Bitcoin just a tad softer. So on the face of it, it looks like barely anything happened last week but for a meaningful drawdown in interest rates. So when you look at this kind of taken together, you really get the sense, well, did anything even occur? But of course, when we look at the reaction to Fed Chair Powell, we see a very different sort of breakdown. And this was the actual sort of day of, by Friday's close, reaction. And of course, what we find here is something that is quite a bit more convincing. And the message here seems to be unequivocally pointed in a direction. So, first of all, needless to say, stocks have a banner day, strong gains across the board, yields down across the board as well. So if ever you were wondering, well, gee, how do I read this Fed relevant narrative here? I mean, clearly the story is a dovish one, just looking at the price action itself. And as we go down the list, that keeps getting reinforced. So you see that we have gains in gold. You see that we have a meaningful sell-off in the dollar. We see that there is a positive and fairly convincingly positive reaction from Bitcoin, up over 4%. So the story here seems to be that whatever the markets heard from Chair Powell when he spoke at the Jackson Hole Symposium in Wyoming, the speech that everybody was watching so very closely to try to figure out if, in fact, the hopium that the markets have been mainlining around rate cuts is, in fact, warranted. The upshot seemed to be yes, indeed, and the market seemed to kind of revel in the realization. And so the message here seemingly unequivocal. What did Powell say that got everybody so excited? Well, going through the comments here, it doesn't actually seem all that one-sided when we first look at it. So the Fed updated its policy framework, as it does every 5 years, and eliminated the catch-up inflation strategy, where essentially they said, after long periods of inflation undershooting our 2% mandate, we're going to have periods of overshooting, or at least allow for that. And we can clearly see that the Fed is changing its tune on this part of the conversation to essentially say, well, actually, no, we're not going to do all that. And in fact, we can see here that what the Fed is saying is the idea of an inflation overshoot has proven irrelevant. And of course it has. Of course it has, because clearly inflation targeting on this basis was adopted just on the way out of COVID. And of course, what COVID did was disabuse policymakers of the idea that they need to be worried about inflation undershooting, because of course they got into a situation where instead they had to embark on an aggressive rate hike cycle because it overshot by a mile. So Fed is kind of cleaning up its act here, as it were, and adjusting its approach. What's very clearly not a conversation in the dovish direction follows, where we see that commitment to act forcefully from the Fed in the new framework to ensure that long-term inflation expectations remain well anchored. This would be the we're not going to let tariff inflation as a one-off get stuck in expectations. Moreover, Powell even goes so far as to say that preemptive action would likely be warranted if there were a risk to price stability, and says that risks to inflation are tilted to the upside, and the risks to employment are on the downside. And this is where things get particularly granular. So notice, preemptive action would likely be warranted should a tight labor market pose a risk to price stability. If the risks to employment are tilted on the downside, though, not so much a tight labor market, even if inflation risks are pointed on the upside. So this kind of gives you a sense for how the Fed is dancing around these conflicting cues for their mandate. Now, this is the part where the dovishness that the markets wanted to see really makes its appearance. Downside risks to the labor market are rising. GDP growth has slowed notably, reflecting a slowdown in consumer spending. We've, of course, talked at length here on this show about the idea that in the first 6 months of 2025, we've had the weakest contribution to GDP from household consumption in 5 years. So that's a reference point going back to the COVID recession, the start of it. And of course, that's not good news whatsoever, because consumption is the dominant share of GDP. It's, as of the latest numbers, 68% of the total. So whatever fuzz you might have from inventories and imports around these tariffs, it's consumption that really matters. And so when you see this kind of messaging here, and of course that's embedded directly in GDP numbers, you get the sense that the Fed is starting to come around to the idea, in particular Chair Powell is starting to come around to the idea that the easing maybe needs to happen now. Effects of tariffs on consumer prices are now clearly visible, and we expect that they're going to accumulate in the coming months. However, this part is key, the reasonable base case is that these are going to be short-lived. Ladies and gentlemen, welcome to Transitory Inflation Part 2. It's possible that tariff-driven upward pressure could spur lasting inflation, but it's unlikely to bring downside risks to the labor market, which is in a, quote, a curious kind of balance. In other words, if the bar for raising rates were tight labor markets threatening price stability. This is not that. And while the Fed cannot allow one-time increases in the price level to be an ongoing inflation problem, we see their conversation about the labor market is, well, we have a slowdown in hiring, but we also have a slowdown in demand. And so we don't really have slack in the labor market per se, nor do we have some sort of a situation that might tighten unduly in the labor market. So the Fed is seemingly looking at this and saying, well, okay, so we can cut, but we're very attuned to these inflation risks, and we're not going to do so in a cavalier way. We're going to proceed slowly. And this perhaps starts to paint a little bit more about what the reaction has looked like subsequently, because consider what the probabilities look like here. In the blue line is one rate cut from current levels. In the orange is rates staying unchanged. Note here that when we start to really worry that the Fed might do something untoward, like not deliver a September rate cut, we start to see it right here. So the probability that rates would remain unchanged, this is going into the end of July, starts to fall off a cliff, and we get to 100% probability of a September cut. Notice this is the September 17th meeting. If this falls to 0% chance that we're going to remain unchanged, well, that of course comports with a 100% chance that we're going to get some amount of cut. And incidentally, at this peak here, the reason you get this dip slightly isn't because it's not 100% priced in, it's because there's a slight possibility that you're going to get a 50 basis point cut. So that there is a likelihood of some cut is 100%. This is the concern that you see in markets going into Powell's speech. So for almost 2 weeks, the markets start to get a little unsure of themselves, and you get to about a 70-30 split. So over here, you're at about 25% chance that you're going to hold unchanged, which corresponds to a 70-odd percent chance. Let's round it to 75, that you're going to have one cut. And then you get Jackson Hole and you start going in the opposite direction. So if you look at the probabilities as of today, you're looking at about an 85 to 15 split, 84.3 to 15.7. What's interesting is this actually brings you back about to where we were before Jackson Hole, but not much else. It doesn't bring you all the way back down here. And so when you look at the price action today, what you find is a near total absence of follow through on what Friday was. So if Friday was stocks up, rates down, dollar down, today you see a very different story. Stocks soggy today. Rates are a little bit higher. Dollar is quite a bit stronger. Gold is flat. Risk appetite on steroids, aka Bitcoin, off over 5%. And so when you look at S&P 500 positioning here, what you find is that, yes, of course, you get a tremendous amount of relief on Friday, but you can't break the high. And you're basically back to where the CPI report got you on August the 12th. So just like here, this was the CPI report, then the markets got unsure. Now they've been reinstated in their confidence that September is in fact coming. And you see the same wiggle right here. Here's the confidence that it's coming. Here's the apprehension. And here is apprehension diffused. Same as you see just here in the S&P. You're not doing anything in terms of breaking ground. You're just stuck back at levels where you were. Moreover, NASDAQ is even soggier. It doesn't even make it all the way back to the high. We just come back to retest the underside of this congestion range in the wake of CPI. And the dollar certainly attempts to make a leg lower, even a forceful one. This is the DXY dollar index, but ultimately holds that support. And this bottoming from July, it continues. We still have a series of higher lows here. So we're attempting to round a bottom. What's interesting is that we're rounding this bottom even as ostensibly the markets got dovish confirmation from the Fed, and as the outlook for next year gets increasingly dovish. So consider this. We still are at just about 50 basis points for this year. That sort of comports with the Fed having done nothing but confirm for markets what they already knew. Indeed, if we look at where the Fed had forecasts set in June, it matched nicely with where it's been all year. If the median rate currently is 4.4, we're looking for a 50 basis point downstep for this year. And the Fed only has 3 meetings with which to do it. So that's a forecast that's becoming increasingly calcified. The Fed is going to have to almost certainly deliver on this now. So for September, we're a lock, it would seem, all but certainly. Those 50 basis points are in the market. Is what we saw as the correct reading of that speech, well, then this doesn't seem to match it. And the positioning, especially in the dollar, which you might think would be substantially hurt by all of this dovish myth-making, what you have is an almost complete reversal of Friday's losses. It really makes one wonder if, in fact, what was on display was game-changing for the trend, be it in stocks or in the dollar, or if instead what we're looking at is just uncertainty around the very near term removed, but with all of the risk that the Fed might underdeliver on stimulus still on the board. And of course, the week ahead is relatively slow in this sense. Not a whole lot of data on the calendar. We can see just a slight smattering of event risk, and all of it kind of backfilled to the end of the week. The most important, of course, the PCE report. And we can see here the expectations are that we're going to get a tick up on both core and headline inflation, up to 2.8% on core, up to 2.6% on headline. That would give us a meaningful sort of increase here. 2.8 on core would be relatively in line with recent numbers. We've been pretty close there in May and in June if we just do a bit of rounding. But 2.6 on headline would be a relatively large reading. Now, we were close in June, but in all, this would be the highest since February, which roughly matches the uptick we've already seen in CPI. Moreover, what's interesting here is that typically the markets are very good at forecasting PCE. Once they have CPI and PPI out, they generally have the components they need to construct a PCE number that is very, very close to what actually occurs, and very rarely are there deviations. We've recently started to see a few more of them. For example, the last month that we had this, the June report, PCE managed to surprise meaningfully higher. So we still have some data risk here. We still could have the probabilities unwind a little. We're at 80%, not 90, where we were, and certainly not the certainty where we were on August the 12th and the 13th. So we could yet be looking at some sort of sogginess here if the September SEP does not match what the markets are demanding of the Fed here. Then there is plenty of room for disappointment still. That data might factor into how we read this, but one day forward from the immediate knee-jerk reaction to Powell's speech, the markets seem strangely unimpressed. And no key levels are broken on either stocks or the dollar or gold or any of the other barometers of how this Fed outlook links with core asset classes. So we're going to be watching very closely this week to see if what we've actually seen is perhaps a somewhat extrapolated buy the rumor, sell the fact kind of a scenario. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Ranigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour, Mondays and Fridays. Though he's out this week. We're back next week. Similarly for First Call with Tom and Chris on Sundays, writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky, and writing and as ever loading all of these episodes to YouTube for your viewing pleasure. If you're watching there, do like and subscribe. Macro Money will be back tomorrow. Happy trading.